when does this sort of stronger seasonality period flip typically? And second, going into Brexit, Trump, 2020 election, maybe less the 2020 election, but certainly the Brexit, Trump type events. I think the positioning by hedgers was strongly to the downside, right? Everyone was hedging for downside risk. Coming into the midterms, are you seeing people hedging and into the November CPI? Are you seeing people hedging upward vol, downward vol, or both? And where could the squeezes happen there?
Yeah, so fairly well documented that skew is in the 0th percentile in the equity indexes right now. So there is less put hedging broadly. But that said, institutions almost exclusively, right, buy protection to the downside. They're fairly, yes, they'll like there are entities that will speculate and buy calls to speculate, but hedging activity, structured products, long vol hedges are to the downside, and so that von Charm effect is almost always on the index level, structured buyback as vol comes down. It's maybe a bit diminished. In this environment, because as we mentioned, there's maybe less put skew demand recently because of the underperformance of the of those hedges, et cetera. But there's still hedges, particularly for that window relative to the stuff around it.
So, okay, and just let's address if you don't mind, the seasonality flip as well. It's before because I have a couple.
I apologize. That's right. Yeah.
So that's good. Yeah.
So, there are several other aspects of seasonality in a normal year. That's why it's a bit more nuanced, right? In an up year, there's just reinvestment of returns. If you think about U.S. equities are about 40 trillion, global equities about 80 trillion or so, global long assets somewhere around 400 trillion, including commodities, real estate, bonds, et cetera. All of these assets in years that the assets go up, which is most years, let's say assets go up 20% in a year or 10%, let's say, that's a $40 trillion that needs to go to work in a world that 100 billion is the kind of the incremental amount that moves markets. It's a massive amount. Now that doesn't all come in Jan 1, right? It's incremental throughout the year, but Jan 1 is an important date. And a lot of this Santa Claus rally and January effect, the two, that month is the most bullish month of the year by far. So those effects into an up market are generally a market where assets in general increase in value and generate cash flow, and it creates a bit of a push at the end of the year. We're in a bit different scenario this year, right? Markets are down, assets are not largely up, so that part of the seasonality will be less pronounced, and you could argue even potentially have a bit of a negative effect this year as you get back into the late December, early January. But yet those von and charm flows is going to be a bit more accentuated, as we mentioned. So there's a bit as you get towards the back half of the year, it remains to be seen here. But when I back half, I mean the back half of December. I apologize, into January is a bit more muddy. So we're gonna say we'll see, but I would say up until mid-December, really up until that December OPEX, really maybe that Wednesday before the VIX-piration of these OPEX there would be largely kind of in our mind the minimum kind of time frame with which we'd expect this to accelerate. Now, obviously, these are flows. This is not the whole story. If the nuclear bomb goes off in New York City, China invades Taiwan, whatever it is, right? That stuff matters. And I'm not sitting here saying that, this is all that matters. This is, you can just map it out. This is what's going to happen, right? These flows interact with the real world and what else is going on and what changes in that world in terms of flows and other factors. But in terms of pure flows and structural effects, all things created equal, that would be kind of the most positive time frame in this window.